Hey everyone, this is Shane with Trade ATS. I just before we go ahead and get started, I wanted to make sure everyone can hear me. If you could just type maybe a Y into the chat, then we'll get moving. All right, perfect. All right, anyways, yeah, just want to thank everyone for being here. We're gonna go ahead and try Thursdays out for a little bit and see if we can maybe reach more people. Kind of, our goal is just to get to as many of you as we possibly can. So yeah, we're just gonna try a few time slots between Thursday and then Wednesdays, and kind of be asking people what works best for them, and then go from there. Anyways, before we get started, just wanted to kind of preemptively let you guys know that we're going to be looking over at some of your trades. So if you've got a trade or a position in that you have right now that you want maybe a little bit of insight on, we love that sort of thing to use as an example, just as kind of a teaching moment for everybody. So again, if you've got like an active order or you traded the New York London session a little bit earlier today and maybe something worked for you, didn't work, or you just want a little bit of commentary on it, feel free to go ahead and type it in to the into the chat, and just try and be detailed with where you got in mostly, and we'll try and figure out exactly where you got in, got out, or give you any commentary. Anyways, that being said, I'm going to go ahead and hand it over to Wade. We're trying to keep the webinar about to an hour today. So yeah, we're going to stay within those bounds, but otherwise it's kind of, just looking over your trades and everything. Anyways, that being said, I'm going to hand it over to Wade.
All right. Thanks, Shane. Want to welcome all you guys to the webinar today. Like Shane said, we're going to probably keep it to about an hour. I have a meeting I got to be in here in about an hour and a half. So, but we're going to try to make the most of the time here. One thing I wanted to talk with you guys about, we do want to, if you guys have some markets that you guys are looking at, specifically we want to address those. I don't know if we can get to all of them, but want to talk about some of those things that you guys got going on that you're looking at. But one thing I want to talk to you guys about is a lesson here regarding pairing timeframes. Oh, hang on, I got ahead of myself. I'm still setting on my thing here. Let me get my screen share on. Hang on, guys. Sorry about that. Okay, should have the screen up now. So. What I wanted to talk with you guys about is pairing timeframes. There's two ways that we're pairing timeframes in regards to telling us something about the market. And the two ways that we're pairing them is for momentum confirmation and for statistical analysis regarding our entries. Those are the two ways that you want to use timeframes. And I want to explain those a little bit more in depth because I think that it would definitely help you guys out with what the trades that you're looking to enter and the carry through on those trades and the expectation. So I'm going to try to keep this as simple as possible. When you're pairing a time frame for momentum, the tighter the time frames get, the more those time frames are going to represent momentum together. And what I mean by that is, say, for instance, what's on my screen right now, you notice that I have a 15-minute chart, or I'm sorry, I have a 1-hour chart right here, and I have a 4-hour chart right here. And those time frames are pretty close. A 1 hour, it takes 4 1-hour candles to make one 4-hour candle, right? When you have time frames close, then those time frames you can read those between each other to see how the move is going to follow through in a certain direction. Meaning, like if we have our expansion line right here, you can see this is a gold against the dollar. You see we have a white expansion line right here. This is our last expansion on the hour, and this is our last expansion on the 4-hour that came up on this 4-hour candle here, came up on this 1-hour candle here. About the same time we got that new expansion. When the price was above expansion on both these time frames, what we're looking for on your directional bias that we teach kind of in the basic strategy, you're looking for carry through. You're looking for the next candle to keep stacking in that direction above or below. For instance, in this case, we have it above the 4-hour expansion, and it's going until we pop this liquidity line up here, then we had that reversal. Same thing right here. We got below expansion. You have 4-hour candles carrying through to the short side. Same thing right here. So that is the basis for the trading. We're not looking to try to call the turns necessarily on our directional bias. What we're trying to do is we're trying to call the turn on our entry. And in order to do that with confidence, we have to have confidence in our higher time frames carry through. That basically we're gonna continue to go in that trending direction. So what can really help with this is pairing your higher time frame. Let's say, for instance, you're using a 4-hour. So let's put this. Actually, let me pull up one more time frame here. Okay, let me see here. Okay, let me get rid of this. Okay, so we have our 3 time frames here, and let's say for your entry time frame, a lot of you guys are using the 15-minute, right? That seems to be the most popular. So what we're going to do is we're going to take the 15-minute time frame, and then we're going to pair it into the 4-hour. This is where a lot of you guys start as your basic, trading strategy, right? But if you're going to take an entry on the 15, okay, for instance, the only entry really in the last foreseeable, for the last day would have been right here. We were below expansion, came above expansion, we got a new expansion, settled above, and then here's your move. It takes off. So that, if you're trading the 15 into the 4-hour, that was your setup. 4 hours clearly long. We're above expansion. Here's your counter trend liquidity. You're going to buy that on the turn, and then expect that we're going to come up, hold above average price, and go into a run. And the reason you have that expectation is because you have the 4-hour, you're expecting carry through. Now, the problem that everyone has is that everyone is scared to death that the 4-hour is going to rotate against them. That's what makes them scared about buying this turn right here under expansion. So the way that you can reinforce how you feel about the 4-hour carry through is to pair it to a higher time frame that's close to it to confirm momentum. So in a 4-hour situation, we can take something like the daily in the situation, and we can pair the daily to the 4-hour and see what's going on with that. In this situation on gold, you see we have a 4-hour and we have a green daily above expansion. So in this situation, when we were coming through here, when this trade took place, this daily was just barely being pulled green, and you can see that we were above expansion. So that can serve as an extra confirmation for the trending direction and give you more confidence to hang into these trades like this. And then also too, not to just cover when you get from, if you bought right here and you get right here, to not take such a small profit, because you're expecting a much more significant carry through based on the more significant time frame confirming your directional bias. So these types of things can really help you stay in good trades and make the most of them as they come through. And in this situation, we did have a big run up. And if you do catch these kinds of runs where they're obviously, you can see the 4 hours taking off, sorry, I had a problem with my speaker. You see the 4 hours taking off, you see that the daily's rotating. In these situations, if you catch, moves like this, you can either get out, you can exit on liquidity lines right here, or you can just wait till you go back into the contraction phase on your entry time frame. Right now, if you were in that trade, it's coming up here, you went into contraction, we broke out to the long side. And right now, if you had a profit from here to here, a good exit scenario would be, I'm going to exit as soon as my 15-minute gets down below expansion. Because at that point, the information is telling you, okay, we're just going into a standard expansion phase across the box, and we're getting down in here. And then that would be a good place to call it. So, that's what I wanted to kind of convey to you guys, is finding more confidence in your entries. It can come from pairing closer time frames for momentum. Whereas with our entries, it's kind of the opposite. We're looking for a statistical analysis on the entry to basically trade against the masses. So in that situation, let me show you the opposite. That's where you don't want to have the time frames too close. you want to have them extra wide so that you can get a decent entry and have a mean reversion to trade back to. Let me show you what I mean by that. Let's see here. Overall, gold's been a little bit sideways here. Let's see. So this last one, it would have been on this daily chart coming up through here, going long on this 4 hour here. And then we have these situations right here. You got a box right here. You get a below expansion coming back. So your initial trade is looking to get back to expansion in trend without the time frame rotating against you. That's really the basics of what we're trying to do, to get in the money and then find that run where, if you're referencing this expansion level right here, we're below, you get above, right here it settles, and then now this is the profit taking zone. How long you stay in this is going to be up to you and where you think the higher time frame's headed. But you want to get the statistical advantage of having the wider time frames for your entries, because if you pair it too close, then what's going to end up happening is that you're going to be trying to buy and sell the rotations, which you can get away with doing that, but it's going to be, you're not going to have the safety net of looking for the mean reversion, which is kind of the secret sauce to what we do. The mean reversion in a trade like this is that basically saying that if the 4 hour is clearly trending long, if I get below expansion, I'm expecting that I'm going to get price activity at least to the reference point, which is the average price of that last expansion. So you're basically trading from your entry towards that average price. That's where the trade starts, and that's what gives us the ability to figure out if it's going to turn into anything or not. So for instance, like this trade, if it came up and it held below this expansion and went down, let's say we never got through it, then that would be a clue to tell you, okay, I may want to close this trade. You close it at a break even, and then the market continues to go down. And maybe it comes down and visits this level here or this liquidity line. And at that point, if that scenario happened, you can reassess the 4 hour at that point and see if it's something that you want to have a better entry in if you still believe in the trending direction. But if you pair the time frames too closely together for your entry, so like you're trading a 15 into a 1 hour and that's it, that's really not telling you a whole lot, because if the 15 rotates against you, it's going to rotate the hour right behind it. Whereas if you trade the 15 and the 4 hour, there's enough separation where the stability of the 4 hour time frame is going to help you see these mean reversion scenarios back to that average price, and be able to plan out those safe entry points and decision points based on the expansion line. So anyway, hopefully I kind of explained that somewhat clearly, because I do get quite a few questions with people, asking, what's the best time frames to trade? What's the best time frames to pair? Should I be trading a 15 into a 4 hour? Should I trade the 15 in a daily? And you guys, I mean, the answer to that ultimately too is you need to trade a time frame that is, number one, relevant to your schedule. If you're trading a 15-minute chart for entry, then you need to be able to look at that market every 15 minutes. So if you're trying to trade a 15-minute chart and then getting to, you have to get to a job where you're not going to be able to see that trade through, you're going to be a super ineffective trader. You can't do it. You may have some winners here and there, but you cannot manage trades effectively from your cell phone. So if your job if it is creating a problem with your trading times, then you're going to have to move to a higher time frame. You'll be much more effective. You'll get bigger moves. They'll take a little bit longer to come out to pan out, but you're going to be much more consistent. So that's the number one rule: is trade time frames relevant to the schedule you can be effective on. If you're trading a 4 hour for entry, say a 4 hour into the weekly, into the monthly, then you're only going to need to check those trades once every 4 hours or so. So you need to decide what's going to be the best for you in your particular circumstances with that. So anyway, hopefully that kind of helps out with you guys as far as what time frames you guys are going to want to pick, what's going to be the best for you. One other thing too is that I wanted to see a lot of people ask you, the biggest thing, especially on the YouTube channel, is everybody asks, how do I know when price is settling above or below expansion? And the answer to that is that a lot of these trades you're going to get a breakout, and you're just going to have to look for an entry on the smaller time frame. But you have to be prepared for the breakouts to come back to expansion if they don't work out. If you really want to wait, if you want to wait till price settles, you're basically looking for the picture perfect situation of that. For instance, like on the 15, we broke out long here, price settles, comes down and tests it, and then we go into a run. If you're worried about trading, if you feel so comfortable trading when the price is settled rather than trading the initial breakout of an expansion, then wait till price settles. The answer to that is pretty simple. Wait till you see it happen. In a situation like this, you see it go up on the 15, you see it come down, and then you see a green. That's price settling above expansion. If you don't see that, and that's something that you're waiting to see for the way that you want to attack the market, then you don't trade until you see that. It's real straightforward. But a lot of people, what ends up happening is that breakouts happen and things happen, like for instance right here, it just goes, and people are trying to figure out desperately, how could I have got some of that? How could I have did that? And the question is, it's not about getting it. It's about trading things that are understandable to you. If you don't understand the price activity that's happening in front of you, then it's not a good trade for you. You only can trade things that you understand, that are panning out in a way that you can make sense of. And the more screen time you get with this, the more scenarios you will see, and the more things you will understand. But that's why we push you towards a very basic methodology to start with, which shows you form a directional bias and look for a statistical advantage on your entry coming back towards your expansion line, towards your average price, to put you in the money and manage it from there. That's the very, very starting point of what you're looking to do. But at the end of the day, it will take screen time. And like I said, the more screen time you get, the more understanding you'll have of different scenarios and what things can play out. And then you'll be able to form trading ideas based on those scenarios. So anyway, all right. So we got some questions that have loaded up here. Let me catch up on those. And I'm going to start addressing some of the things that you guys have said here. So hang on, give me a minute to read up here. And I'll be right back with you. Okay, so the first pair I see is Aussie NZD. Let me pull that up. Oh, there it is. Okay, Oberlin, I see you put this in here, and I see you gave me some feedback on what you're trading. Okay, 4 hour under expansion, 15's above expansion. Let me take a look. Okay, I like it. I like it. 4 hours ran a little bit. Your grade A opportunity was right here. So if you're running the assistant on it, you should have got a grade A. Yeah, should have got a grade A or a grade B. I don't know what happened right at this moment here. You may have got a grade A right here. I wasn't watching this particular one, but should have got a grade A or B right here. Looking at that, looking to work that market, definitely short. But yeah, I like it. Right now, if you sold on this one, you got 15 above expansion. Sell the turn. Your initial, what you're looking to have happen is come basically to this expansion line, just like it's doing. That's your initial get in the money. So you've kind of bought yourself a ticket onto this train, right? So right now, you're just trying to cover your spread, get in the money, but your decision and what's going to happen is going to happen at this white line. That's the tipping point. If we get below that white line, we hold, and then we make a run down, great. And then you're looking to these liquidity lines to cover and where you ultimately think that the 4 hours headed. So 4 hour could definitely get a mean reversion back to right here. So that would be kind of, if I was looking to ride the 4 hour, I'd be looking for a profit target right here at this expansion, which is one spot 06794 roughly. So if you measure that out, that's an expected profit of 648 points. So that kind of gives you an idea if you have any reference points here. So this liquidity line right here on the 15 would kind of be your profit target, which is referenced with getting a mean reversion to this expansion. One thing that I see that makes me kind of like that as well is I see a master cycle happening here on the 4 hour where we had a box form, swing high, swing low, swing high, swing low. So this is that kind of idealized situation, the point of origin to the master pattern cycle, kind of like in the video. Here it is, you break high, break low, break high, and then with that expansion, we can come to the conclusion that there should be a lot of follow through to the short side of this expansion line because you can see the master cycle unfolding right here. So that would definitely be a scenario, I think a decent probability scenario that you would get at least to this level. Now, if we get down to this level, you hold above this expansion level right here. Let's say price comes down, holds above, and comes down, kind of goes sideways right here, and then you get a big break to the long side. That's probably going to be the start of a huge long move, up into these liquidity levels up here. Because eventually, when you get the master pattern cycle coming back and forth, you got break high, break high, that overall expansion. When you can spot the master cycle, and eventually it's going to stop breaking highs and lows. It's going to stop the whipsaw pattern, and when it does, that's when it picks a side for the next big trend. So anyway, something to figure out. And then your reference point for the overall cycle would be this expansion level right here. This is the most significant one to follow through all the way in which, so right now you're basically getting under that on price. So yeah, I would look for some carry through. The only variable to this trade that I would be somewhat worried about is that session's pretty much over right now. Granted, this is Australia and New Zealand. So if there is going to be some follow through on these pairs, it'll be, it'll start to kick up here pretty quickly. But these pairs, often most pairs are going to have their biggest reactions in London, New York, just because everything follows those major currencies. So, but yeah, I like it. Right now I would just manage your risk. If you got much above this active high, I would probably close out the trade. If you see that it's holding above this average price and you start to see a reaction to the long side, I would take a loss right at this high in here somewhere and look to see if you get a better entry up towards this expansion. But I would hold your directional bias. I would only be short on this pair personally, just seeing what's playing out. But I would see right now, I wouldn't be worried about taking a loss here because you may be able to get a better entry up here. And I would still use this expansion line as your reference point, because the facts are, if that 4-hour holds intact, especially in line with that daily, facts are is that you're coming back to this expansion. It's going to be like a magnet. So if you deviate, up here to this, that's 358 points away. That's 358 points coming back. It's going to be just like a magnet to that, and it could happen 5-6 times. You just keep magnetizing back, back to that level, back to that level, back to that level until you hold below, and then get your actual run. And at that point, you're just going to manage the profit on that as far as you can. So let me see here. Okay, let me get to another question here. Hang on one sec. Let me do some reading. Okay, so let's take a look at dollar CAD. Dollar CAD has an interesting setup happening right now too. Okay. So dollar CAD, let me show you. Let me switch this over. And this is going to be a weekly time frame. I don't think it's quite ready yet, but it could be a really good setup coming back to this expansion line right here. Daily's pulling long here, but as long as we hold below this average price on the daily right here, you're going to revisit this expansion line. So right now we have a deviation of 1,068 points. So there's definitely, this is an interesting setup. And the reason I like it too is the weekly is short. Weekly short under expansion. Yeah, we're getting kind of a pullback on the candle, but until that turns green, we can easily whip back down to that active low, easily. Take a look at the monthly. Also, what I like about the monthly, talking about price settling, that monthly, that's a powerful candle on that monthly chart. So if that holds short, for sure, the run we're getting up on the daily, this 4-hour run, yeah, we may come up and visit these liquidity lines here, but this is something that to me is definitely worth babysitting. Maybe start testing some positions at this point. And if we get up here, I would probably add to this position as well, because like I said, if that 15 or that monthly holds, you are at least getting back to this level. And right now, like I said, that's over 1,000-point deviation. Let's say worst case scenario, you get up here, that's a 1,685-point deviation. And like I said, if that holds, you're coming back here, guaranteed. So you can kind of map your expectation based on just the initial getting in the money on the trade. And then if we hold below there, then you got these liquidity line levels to work with to cover extra profits. But remember, what we're trying to do is we're just trying to get in the money in trend so that we can see what happens. We're trying to make profits testing trades, essentially, because the trade is going to be, if you're shorting this, the trade's going to be considered a good trade when you get back to this level. The trade's going to be considered a runner when we get below that level down in here. So all we're trying to do is we're trying to work the probabilities, the statistical advantage that we see that the bigger crowd, the bigger time frame is short, but we're getting a short-term spike against that, and we're basically betting on that this is a pump and dump. It's going to get pumped out, it's going to get pumped up, and it's going to dump back to this expansion line. That's what we're doing. That's our initial, game plan for this. So anyway, I like this. I think this is a good situation right here for a longer term setup. Today it just kind of went sideways in the session, but definitely have a short bias on this. I think that it could be a really awesome trade coming back to this level. I love when I see these dramatic deviations against the weekly and against the monthly, especially. You got those two time frames talking about pairing time frames that are close together. When a weekly lines up with a monthly, what does that say about that weekly candle? Does that say you should go long? Does that say that you should have a short bias? Because everyone right now, let me put it. Let's go back to the basic indicator. Here we are. Everyone who's not looking at ATS is looking at some sort of average base indicator, and that's pointing long. You even look at that spike down that held here on the 4 hour, and it could go long, but the statistical advantage trading against those people is short based on the higher time frames. That's where you can either jump in long based on a small momentum trade, and there very well may be something there, but the bigger opportunity is to the short side. And you have an exact price target, which means you can quantify your risk based on what your expected reward is. That's the magic with expansion lines. They're exact. Even out of trend, if you just look at the general map of ATS, look at the spike today. Where did it stop? Stopped at a previous expansion level. So for whatever reason, if you were working an opportunity buying below this breakout right here, if you felt like you're going to get a reversal, you can quantify your risk as you buy and layer in positions based on an exact price target of this expansion line. And I guarantee you won't find anything more accurate than coming back to those levels. As far as understanding, I expect this exact amount of pips to a profit target or to a decision point. Not going to get anything more accurate than that. So would I've recommended this trade? No, because the easier way to quantify it is trading in a directional bias. Because a lot of people, you don't want to have to risk going so negative on a trade before it comes back. I'm just pointing out the fact that it happens even against trend. And you can work those opportunities the more experience you get. But the easier way in general is to kind of basically just go off of the directional bias and catch deviations out of trend, like what's happening now against the weekly and against the monthly. So anyway, I like this opportunity. Something I definitely maybe start testing a position. Right now, maybe one position, maybe 1/5 what you would normally want to trade. And then if you get up here, a couple more positions. And then if you get up here, then it's probably, basically if you get much above this expansion line on the weekly, that's where I would say forget it, because in that case, we're probably going long. And let's talk through that scenario. Let's say you do put in a minor position here to test it, just in case it comes back, you want to have some skin in the game. Let's say it gets up here, you layer on a little bit more because it's still not a bad trade. It gets up here, now the weekly's green and you're through expansion. Okay, now what I'd be looking for is a possible exit, because at this point we could be bringing the monthly around as well. And at that point, the information we're trading on is changing. So what I would do at that situation, look for a new contraction phase, look for a green weekly candle to hold, then look for a dip down, close out these old positions on the dip down, buy into the new trend, go long, and then catch the weekly going long at that point. But you'd be looking to exit your positions at the best price possible if your information changes that way. But like I said, I don't know what's going to happen. I just know that the probabilities that I like are with the weekly and the monthly direction because those are stable. So I would rather start my trade sequence based on understanding where the probabilities are on those higher time frames. And that's where I would recommend you guys stick to as well. Okay, let me catch up on some reading here and check into some more questions here. Hang on. I'm going to check out NZD USD real quick. Okay, Avery, I want to address the what you just said about NZD USD. 4 hour and the 15. Well, I'm reading your comment here because I know you're having some trouble with this and I want to address it for you. Okay, so the 4 hour, trading the 4 hour into the daily using the 15 as entry. Okay, daily's clearly long. 15-minute has gone short for the moment. So let's see what's happened in this area right here. The 4 hour is definitely we got a red candle, so something to look at there. But the daily's definitely still long. So you got to look at what prices are we looking to trade back to. If you went long on the 15 right here, this would have been a point of basically what you're looking to get back to in trend with the 4 hour. This was made within a 4 hour green candle. So you had a situation, this is what I was talking to about getting better prices. Let's say you bought at the rotation right here, looking to get back. It doesn't get back to the average price. Let's say you take a loss right here as the 15-minute goes against you. Has the information changed? I don't know. I wasn't looking at this at the moment, but if this candle was still holding green and you see your daily still long, then your directional bias is still long. Even if you take a loss right here buying and then you take a loss, this is just a better entry to get back to this expansion point, which it did happen. So if you bought this right here going back up long, then you're good to go. So I don't know exactly where you got in, but you got to look at that activity, look at the fact that we came up and it did. You got to look at, when you're analyzing a trend, you need to look at what trades have already paid already, not necessarily what trade you want to enter in. Because if you look at the activity of past opportunities, that will help you predict what the possibilities are going forward. If I see a trade has already come up and tested this line here, it held this liquidity, it didn't blow out this liquidity. That's telling you that that we could be headed back into another short run, and it's already paid. It's had a chance to trend. It had a chance when this happened. It had a chance to get over this expansion line and go in a run. And what did it do? It didn't run. So in this situation, coming down through here, you wouldn't have bought any of this. Because right now, you are under expansion, but the fact that this line's already been tested, I would have waited for a new opportunity. So if you're going to get into a trade right now, you maybe would have entered below this expansion, but at this point, the 4 hours rotating against you, and obviously we're getting out of we're getting out of session here. So I don't know exactly where the trade went against you, but if you shorted anywhere in here, this was probably not the greatest, because now you have this reference point that could be taken over, and that's what we were gravitating towards as well on the short side, even though it's not represented on the 4-hour. So really the only opportunity I saw, I see that was in this whole situation right here was a short right here that you probably realistically would have broke even on or lost, and then getting back in, still trading back up towards this. In this situation, that was a potential, 260, 270 point move. And that was it. And you probably wouldn't have got all that realistically because we didn't hold above average price. You probably would have been getting out on this rotation here. So in reality, it's basically a 200 point move is what I see was here. And that's about it. Anyway, hopefully that analysis helps a little bit. We're not going to win every trade. We're either the trades that if you're doing it right, if it goes against you and you get out, then you're either going to get a better entry or it's a full-blown reversal. Two things are going to happen. So you have to look at the pieces like that. It's like, if I didn't get paid on a trade, why? What does that say about the future of the market? Because it will always in trend, it will always revert to the mean of the average prices of the expansion lines. It will always come back as long as the trend stays intact. So if it doesn't get there, again, you got to ask yourself, am I going to get a better price in trend, or is it a full-blown reversal? Because one of the two things is going to happen, and it's up to you to figure it out sooner than later. So, okay, let me catch up on some more questions here. Hang on. Just want a quick comment on your comments, Mark. Sounds like you're doing awesome, man. Just keep it up. So just want to tell you, I saw previous comments. Looks like you're absolutely tearing it up. So thanks for sharing. Sanjeev, I see the question about the running the assistant on the minute, the M15 and the H1. Can you clarify that a little bit better? Are you trading the 15? You're running the assistant on the 15 minute using the 1 hour as your directional bias. If that's the case, those timeframes are too close to run. It's not going to give you an accurate picture. You need to run the 15 into the 4 hour or the 15 in the daily to get a better signal. But please clarify what you're doing, and I'll address that a little more. I'll address it further. Hang on, still reading, guys. Okay, we're going to look at the Aussie yen. Let me pull that up here real quick. Okay, Ronald, checking out Aussie yen. I think you might have spotted the trade setup of the month. um, I like it. I really like it. Let me take a look here. Let me get in tune. Okay. So what's our deviation? 811 points, coming back to expansion. Long on the week, above expansion, with a brand new rotation on the monthly, off of a liquidity line. Dang. A lot of good things happening on the long side. Yeah, I definitely babysit this trade. Definitely look to go long. Possible points where it can go against you. These liquidity lines here. I would look to hold above average price on the weekly and see if we hold right there. So I would add to this position up to about right here, and probably my catastrophic stop would go down around this level in here. Because essentially what you're looking for is you're looking for these expansion lines right here to hold trend. So if these expansion lines hold trend right here, you may come down. Remember, the expansion lines are like magnets. So it'll come down, it'll blow out people that have already gone long on this. They're seeing the rotation. It'll blow them out all the way down to this point of origination down here, and then reverse, and then head back up. So your magnet point of mean reversion is this level right here. So that really is what you can set your risk to reward based on, is that you're going to come back to this level right here if that weekly holds. So I love it. I love the deviation. I love what's happening. So yeah, this is definitely one I would be working. Looks good. So let me catch up on some reading here. We got a few more minutes. Like I said, I'm going to try to wrap it up within a 1 hour time frame here. But I see we got a few more comments. I'm going to try to address those. So hang on. Hey, Avery, I see your comment about the call. Go ahead and send us an email, and we'll try to set something up for you. All right. Definitely want to make sure that you're seeing it well, and I know you're dedicated. So yeah, shoot us an email. We'll try to work something out with you. All right, with that request. go ahead and send it to admin, the admin email, admin@tradeats.com. Hang on, just still reading a few more questions here. Hang on. Okay, Sanjeev, thanks for following up on that. So you're running the assistant on the 15 and the 4 hour and the 1 hour into the daily, and you're looking for a double signal confirmation. So you're looking to basically get a signal on the 15 and on the 1 hour that's basically the same as an extra confirmation. I understand what you're doing. That may get a little confusing at some points. What I may suggest doing, if you find that that's working for you for that extra confirmation, then by all means go for it. I encourage people to test certain things just so you can prove to yourself what you understand the best. What you may want to do though to simplify your life is to take, if you're predominantly trading on a 15-minute time frame and you can be around for the London New York sessions, then maybe what you want to do is just have the signal on the 15 into the 4 hour and only take the signals where the 4 hour is aligned with the daily. So just have, basically you got your 15-minute right here that's running the assistant on whatever you're trading, and you got your 4 hour right here, and then you got your daily right here. And then when you get a grade A or grade B signal, just see if it makes sense with the daily before you take it. Because remember, the signals, the entries are all about follow through on your higher time frame. If you don't, just because you're getting an A or B signal, let's say if it's a 15-minute into the 4 hour and you get a grade A signal and you look at the 4 hour, because if the signal is going to pay, it's based on the 4 hour follow through in the trending direction. But you look at the 4 hour and you're like, that doesn't make any sense to me. Then that would be a signal that you may want to filter. But if you want the 4 hour to follow through, you may want to reinforce it with the daily trend. If it's in line with the daily, then that's something that you can take a look at. So anyway, I think maybe that may serve as a better filter rather than getting multiple signals and waiting for them to line up or trying to analyze if they did line up or not. What I've found is the simpler the better. A very simple setup, something that you understand, that makes sense to you. You understand where the risk points are, where the turning points are based on the expansion lines. And if you're too far away from your risk point, then maybe just leave it alone. So those are the things. As traders, we can't control the markets. We can't control when they move, how big they move. We can't control any of that, but the one thing we can control is the opportunities that we decide to engage with. So if the opportunity isn't something that you fully understand and recognize, then the best thing to do in those situations is keep your capital on the sidelines and don't risk anything. That's really all it comes down to. You look at Warren Buffett or any of the great investors on Wall Street. People ask Warren Buffett, how do you got to get involved in Bitcoin? How many Bitcoin do you own? And Warren Buffett's like, I don't own any. And people can't understand why he doesn't get it. And the reason why he doesn't invest in it, well, number one, because he's seen enough price ups and downs to understand that it's a boom and bust cycle until it gets mass adopted. It's all it's going to do is pump and dump until you're actually using it to go buy groceries with. But he's not going to get involved in it because he doesn't understand the technology. It's ahead of his time. He understands Coca-Cola, and fundamentals of companies. So just relating that thought process when it comes to a technical setup or what you're doing, you need to take setups where you understand the price action. You've seen similar things unfold and you understand how to manage it. If you don't have that sense of feeling around a trade, then it's just something that you just want to watch. It's not something that you want to engage with. You still want to get the experience. You want to see the price action and learn from it, but you don't want to put your capital on the line because you can't mitigate your risk, as effectively. So anyway, we're going to go ahead and wrap it up, guys. Hopefully you guys got some key takeaways from this. We'll plan on doing another webinar next week. Just some quick announcements. We do have a bunch of stuff in the works. I know I've been saying that. It's just been a massively heavy lift to try to get a lot of the stuff we're working on ready for you. We have some software updates that we're working on, some new online course content that we're working on, that's basically going to go deeper into how the software works, the programming behind the signals, and how, basically how this is following the market maker patterns and basically documenting their footprint, how that all works. So it's a kind of a more advanced class from what's there right now. Not that what's there isn't good enough, but I know a lot of you guys you don't want to know just how to tell time. You want to know how the watch works. So I'm putting together some more advanced pieces for you guys to delve into, and hopefully you guys will get some benefit from that. So anyway, appreciate you guys being on, and we will see you guys next week. Everyone have a great day or night, depending on where you're at. We'll talk to you guys later.